Hi, and welcome back to another episode of Darwin Investors. I'm Money Train Mike. I'll be with you all by myself here today. It's the day after Christmas. Magic Mike and Jory and John, they're all hanging out with their family, as am I. But I'm taking time to make this video. What I'm going to talk about today is going to be the week in review. Basically, what I got right, what I got wrong. Should we expect a Santa rally or not, or am I expecting a Santa rally? I might briefly cover 2021 in review, but it's going to be really brief. And then what I expect from 2022. So as I look at this week in review and I look at what I got right and what I got wrong, the one thing that I was going to do was I was going to sell puts on NVIDIA. And that was, I didn't say I was going to do much from a buying standpoint. We had Omicron fears last week, and so wasn't sure that I was going to get buy too much. I wasn't going to go buy this dip. I already bought the dip in early December, and so I'm pretty much all maxed out as money that I'm expecting to put in the market is concerned. So I ended up selling some puts on NVIDIA, and so I made $339 selling puts on NVIDIA. What does that mean? I'll make a video to detail this, and we'll just go into this in more detail. So if people want to follow along with what I do and how I try to maximize my returns in this market, in a sense, this becomes a little bit of a dividend. Which by the way, NVIDIA paid a dividend. Yesterday made $4.04. And so what I mean is that, so on December 20th, I sold a put that had a $270 strike price, meaning that if NVIDIA finishes below $270 by the 23rd of December, that I would agree to buy one contract or 100 shares of NVIDIA at $270. Now, it's only if it finishes below $270, and someone paid me $587 to make that bet. Now remember, the NVIDIA opened the week really low. Let's see where they opened at. They opened at let's see, it would have been NVIDIA 5 days ago. They opened up pretty low, so they opened up at $279, got as low as $278. 274, 272. So my bet on them under 270, you can see why someone would pay me this much, because it was that close. But I like the price and I like NVIDIA, so I'm willing to sell this put. And that's one of the things about selling puts. You got to make sure it's something that you want to own or you don't mind owning. And so I did that. I sold a bunch of puts, and you might say, well, why didn't you just do this one and not buy it back for 570, or this one for 564 and not buy it back, or this one for 604, I bought it back for 515. If you just done your original one as it ended up the week here at $296.40, I could have kept all of the money, all 587, instead I only got 339. Well, for me, options aren't like buying and holding stock. For me, options are for taking quick profits. I don't like to let those things ride. So I'll go into more detail with options on another video, but for now, let's just say that I made $339 on NVIDIA last week selling options. I also thought that Airbnb would go down last week because of Omicron, and apparently I was wrong there, and thankfully so. I didn't buy any more, but I guess I made I have 100 shares because I like to have enough to sell contracts on them. So I bought 100 shares. I've already had it, and it looks like I made about 1670 last week just on stock appreciation or share appreciation on Airbnb. I would expect that Airbnb, it likes to poke up over 200. What I'll end up doing is when it gets to 200 again, I'll just put a trailing stop on it, about maybe 2 or 3%, maybe 3% trailing stop on that. And what that means is it helps me, I'll get some profit out of Airbnb. I'll follow it up. End of the day, I like Airbnb. I think it's a company that's definitely, I like it more than I like Marriott or something like that. I know when I travel, I prefer to have places like this. This is why I own the stock. I like it. I like their thing. One of the things that happened last week was Joe Manchin. He said he didn't want to do the Build Back Better plan. And so let me see here if I got that. What was the Build Back Better plan? That was, so I didn't know what exactly it meant for Build Back Better. Like what does it mean to not have that? Because I know that the infrastructure bill passed, and that would be good for, you know, your Caterpillars and Deeres and Nucors of the world. But what was Build Back Better and exactly what was in it? Well, this bill, it had a lot of provisions. According to this, it included $555 billion to fight climate change. So I'm guessing that would be your solar stocks and things of that nature. $400 billion for universal pre-K, $200 billion for paid leave, $165 billion on healthcare spending that would help reduce premiums of the Affordable Care Act, and a $200 billion to extend the expended child tax credit for an additional year. So these look like, this is like some of the stuff, or maybe all of the stuff that was in this bill. So what effect did this have on the market? So there was $555 billion to fight climate change. So I immediately thought, okay, what did that do to solar stocks? Now this was shot down last Sunday, so we could go today. So the worst day would have been Monday. So let's go look at Enphase Energy. This is a very popular stock. If you go back in the month, it's been declining, but this right here, they said, oh, the bill is shot dead. So let's see what it went from 190, and then on the 20th, it got as low as 175. So it lost, oh boy, what is that, about 7.5%, but it's since rebounded. I looked at SunPower, and it took a mighty fall. It went from 2144 down to 1967. So percentage wise, that was a good thing, but a good dip down by 8.5%. But again, it bounced back. And I look at First Solar, it did the same thing. It plunged straight down on the news of the Build Back Better was gone. And then it's kind of stabilized. I'd say of all these, Enphase seemed to be the one that bounced back the nicest. And that's interesting because it's the one that, according to the PE ratios, seems to be the most expensive. So it must be the one with the most growth, or the one that this one's got a PE of 20. This one's got a PE of 11. And Enphase has a PE of 164. So what this tells me is that people see that Enphase is a nice growth company, one that they would rather put their money there than, say, in First Solar, for instance. Maybe this is a more mature company. Anyway, so the child tax credit, excuse me, the bill to fight climate change went down. That was our impact on our solar group. It looks like they all took a dip, some more than others. Let's see, universal, $400 billion for universal pre-K. I guess my personal feeling on that one is that I think that we might try to find a way to pass that one, I would hope, because when I think of $400 billion for universal pre-K, what I'm thinking is, what if you've got like a single mother who can't work, and now the government's got to send money to that single mother because she can't stay at home and take care of, you know, like she can't go to work and make enough money to make it worthwhile, like she's spending it all on childcare. I'm just not sure what the government spends on keeping that person home and paying them versus letting them go to work and having some sort of universal pre-K. Bill, I'll bet you it's somewhere in, I'll bet you it's something like that. I'll bet you that, but also it would also help our economy to send them back to work, and you know, help some of these companies find people to work there, and that sort of. This actually might be something that they want to have another look at to try and keep this one rolling. I think that one's a good idea maybe for our economy. I don't really know all the numbers, but that one, in my opinion, should probably have they should take a look at that one again. $200 billion for 4 weeks of paid leave. I don't know what that's all about. $165 billion on healthcare spending to reduce healthcare premiums. Again, if this is true and it's going to reduce healthcare premiums, again, this one can pump more liquidity in the market. This one here could also potentially pump more liquidity in the market, as if you can go to work, you have more money, and then you can spend more, and you're, you know, a better consumer, and the government doesn't have to give you as much. So this one might pump liquidity into the market. This one might pump liquidity in the market. I'm not sure about this one. Let's see here. The bill will also grant $150 50 billion each to expand affordable home care and affordable housing. Okay, yeah, I mean, the less people living on the streets, the better. I'll go with that one. A major provision of the bill is $200 billion to extend the expanded child tax credit for an additional year, while also extending the earned income tax credit. Okay, so what this one is, this is almost like extending you know, those stimulus checks to people. So while it's good for the stock market to hand out $200 billion here to the public, maybe just handing out money like that isn't the best for the overall economy. I don't really know, but at the end of the day, the solar stocks took a bit of a hit. It might be because they're thinking that this might come back around. I don't know. So next thing, so the Santa Claus rally. What are we expecting for the week coming up? Well, I'm not sure if we're going to have a Santa Claus rally. I mean, nobody really is, but this article goes on to talk about a bull and bear case for, will we have a Santa rally this week? I know myself, I'm personally just leaving my money in the stock market. On red days, I'm going to sell puts on Nvidia. On green days, I'm just going to let it ride. Maybe I'll sell some puts if it takes a dip in the day. Sometimes I can't help myself trying to make like 50 or 100 bucks in a day. If it's sitting there waiting for me, I'll take it. But the bull narrative, it seems to circle around Omicron here. And that's interesting. I'll come back to that in a second. But the uncertainty for the Santa rally circles around Omicron. But so the bulls say, this is the bull narrative, it says that Omicron is highly contagious, but only for those that, are fully vaccinated and had a booster. You know, it's like, it's something that goes kind of unnoticed almost. You know, you got, I guess the big symptoms are some fatigue, a little bit of fatigue, which I think most people suffer from every day, you know, anyway. So it's kind of hard to tell if that's Omicron related. And also a runny nose. Those are your two symptoms, is the runny nose and the fatigue. And so most people that have Omicron don't even know they have Omicron. Even Jim Cramer was working this week, and he tested positive for COVID, and he was still working this week, and he looked like he was doing just fine to me. So Omicron, it almost seems like, in a strange paradoxical sort of way, good news for the economy. If that's going to be our dominant strain, and apparently it's 70 to 80% of new cases are Omicron, if that's going to be our dominant strain, and the worst you're going to get is a runny nose and some fatigue, well, you know, maybe that's not the worst thing in the world. So there will be no mass shutdowns of the economy. I know we're having some sporting events that are canceled. You know, I think NBA and NHL is canceling some things, and little things are being canceled out of there. But by and large, the economy is just open, and we're not going to shut it down. I could go to Macy's right now if I felt like it. You know, nobody shut down Macy's. A lot of people think the bottleneck supply chain issues will ease in the first half of 2022. Makes sense. If there's less liquidity, there's less demand, they're going to require less supply. So yeah, I would say because of a reduction in demand, that that we would not need as much supply. And of course, then that would mean that our supply chain issues will ease pretty organically. I mean, they're just going to ease on their own. They say because of this, the Fed will be less aggressive on inflation. And I think the Fed's going to be less aggressive on inflation for a different reason. I think it's because the inflation will not be, it's going to ease up on its own. And so they're not going to need to crank up interest rates as many times in 2022 as people think, but we'll get in that in a minute. And the biggest thing is the consumer remains strong. Our companies are having record revenues. They're having record operating margins. There's just, they've never done so well. The consumer is out there spending money like crazy. So the strong consumer and the strong economy is reasons why it's believed that the Santa Claus rally will keep going this year. Now, one reason that the bulls or the bears might say that it's not gonna keep going this year would be of Omicron. You know, they're basically the same thing, that, which I think is ironic. The the bear case and the bull case is the same thing. The bull case is like it's going to do better because Omicron is because of Omicron and it's not very lethal. And the bear case is that Omicron will lead to more inflation. So it's like, I guess it's like people, two people looking at the same thing through a different set of glasses. But I tend to be more on the bull side of this. I'm always on the bull side of everything. Anyway. But I think this is interesting here. I just noticed this when I was scrolling down this article. I kind of read this as I went down, and it was that technology since November 29th, and I'm guessing you could probably extend this further back, probably to the beginning of the year. But the S&P technologies, your FANGs, your big cap stocks, those ones are up. Semis are down. Now I know they're up for the year. Software is down, and ARC innovation is way down, and that would be more of your small cap stocks or some of your growth stocks, or some that are like maybe not profitable or barely profitable. So it looks like those with big earnings have been doing really well since November 29th, while those with no earnings or less earnings are not doing as well. And I expect that that's going to be a theme that's going to keep up through 2022. As a matter of fact, if I had to make a theme for 2022, that's the one. At least that's the way I'm going to look at going forward. Now, remember, I'm not a financial advisor. I'm just a guy on the internet that's just telling you what I'm going to do for the upcoming year. But what I plan on doing for the upcoming year is I'm going to go ahead and I'm going to just keep on investing, but I'm going to switch what I invest in just slightly. I'm going to move into less volatile, more quality. They're all quality stocks that I believe that I invest in, or I would invest in them, but just kind of like less volatile, better valuation. I guess it's a better way to put it. Better valuation, something that if the market goes down, that it won't go down much. But I think that they're going to be stocks that that I think have less downside risk, or stocks that I believe that with high interest rates and high inflation, that they'll actually work for them. That'll be like a tailwind for them. Let me go ahead and share my screen here. So looking forward to 2022, we'll look at what the Fed is going to be doing right now as it relates to tightening and interest rates, and when we can expect interest rate hikes, what that maybe means for the market, and what are going to be the types of stocks you might want to own. What are going to be our outperforming sectors? What are going to be our underperforming sectors? And so these are the things that I'm kind of looking at, and that's how I'm going to play 2022 after earnings gets released. So let me show you what I mean here. Let me go ahead and share my screen again. Share this. And so the Fed is, let's see if I, the Fed is doing a taper right now, as we all know. And what had originally happened was we had $120 billion that the Fed would pump into the economy every single month. $120 billion, $80 billion of that would be buying back US Treasuries, $40 billion would be buying back mortgage-backed securities. And what they said originally was, we're going to do a taper, right? And our taper is going to knock off $15 billion a month, or $10 billion off of US Treasuries, $5 billion off of mortgage-backed securities. But then they had the meeting in December. They said, we're going to double the taper. And so what that meant was, instead of 10 and 5, they're going to go to 20 and 10. So they're going to basically, in December, at the end of this month, expected that they will buy back $50 billion in Treasuries, 25 in mortgage-backed securities. And then in January, this will be the balance, 30 billion and 15 billion. And in February, our balance will be 10 billion and 5 billion. And in March, the taper will be complete. And that's what Fed Chair Powell said they were going to do on December 15th when the Fed met. And then after that, we're going to do some interest rate hikes. And at this point here, I don't know what, I just don't know what direction the market will go in, but I'm going to try and get into stuff that I believe that the interest rate hikes and that sort of thing kind of maybe helps, or like inflation helps or something. So I would expect that here in January, we're still going to be okay in January. I'm going to basically really alter things here in February. And the reason why I'm picking January is because, here, let me go ahead. I'm going to stop the share here. And then I got to get into this here. It's like my personal financial information. I don't want to expose it to the world. The reason why I'm going to stop it in January is because of earnings. And the January is traditionally a very strong time of year for the markets. Why is that? Well, I've only been in the market since March of 2020. It was like my hobby. It was a thing I just kind of got into, and I've just learned how to do this just by, it's a hobby. It's something fun that I do. But in March of 2020 is when I got into it. What I noticed is that right around earnings times, these things seem to spike, right? And the stock market seems to go up because all your bears, they're always going to have their case about why the sky is falling. But then the earnings come in, and at least for like the last couple of years, the earnings come in and they're like, well, these companies are fine. They've never had operating margins like this. They've never had revenue like this. They're beating every single earnings, top line, bottom line. They're triple beat after triple beat after triple beat, and it basically, it squashes the bear argument. And so the thing I'm looking forward to in January is if you look at companies like Apple, they report on January 26th, right? If you look at like Microsoft, they report on they report their earnings on January 25th. And so I expect that this rally is going to continue. It'll obviously have down days, that's fine. But I expect by and large, we're going to get a little bit of a continuation of the rally up through this earnings week right here, in which case after this earnings week, I'm going to readjust my portfolio. And what am I going to do? Well, when I look at, here's a stock market right here. Here's what stock market investors, I think this is what a typical person's portfolio might look like, right? They do this, they get in, they're Warren Buffett, right? They're reading Intelligent Investor, they're like investing in stuff they know, Microsoft, Apple, Home Depot, and that sort of thing. And it's just kind of like, it's like creeping along like this, right? It's like creeping, and then it's pretty steady, a little decline, but then creep, and then, basically will look something like the S&P 500. But then all of a sudden this will happen. You're going to have that day where you make like all kinds of money, right? And so that day will happen. And so all of a sudden you're not happy with this anymore. But and when this happens, it's kind of like an adrenaline sort of surge, like, whoa, my net worth just doubled in the stock market in like 1 day or 2 days or whatever. And then you kick around like that, and then all of a sudden, wham, it goes way down like that. Maybe you discovered options on that day. I don't know. This is when you started doing call options. And all of a sudden now you're below where you started just a few weeks ago. But then you kind of creep around in here, and all of a sudden you get lucky again, and you're like, whew, got my money back. And then you're like, all right, okay, I think I can get it back up here again. I no longer like these kinds of stocks. I'm always going into something a little bit more speculative, and it went up. I knew it. And then you go, and then it's like, and it goes down. And so I think that 2022 is an awful year for this. Well, really, any year is an awful year for this. But I think that 2022 is going to be a year that you're going to want to go back to your roots, and then just kind of find those low volatility, high quality stocks. They're going to take you through to the end of the year. So, because like for 2021, let's see, in 2020, I had a 90% return. In 2021, I've had an 85% return, but I'm projecting that in 2022, that I'm going to have about a 10% return. Well, I'm going to try for a 20% return, but I think that the market overall is going to have a 10% return. And I believe that the returns are going to basically, we got to get through the interest rate, like the first of the interest rate hikes. And then I think we're going to basically not rally until, it's going to be a while. It's going to be a long summer. I think we're going to have probably a decent June. Let's see, January earnings, February, March, April earnings, but interest rates high. May, June, July, August, this is going to be another decent month, earnings. And then November earnings. So we're going to have a good August. We're going to have a good November. We're going to have I think we'll have a good Santa rally again, and no reason to think not in December. But I think that most of our big gains are going to happen when all this fear here is over with. So I'd be walking really carefully here between February and I'd say June. Be really careful. Get really, I'm not saying go all cash, but I am saying that what am I going to get into? Well, the stocks that I really want to get into are going to be the oil stocks. And I love financials, and I know my brain tells me go oil stocks because in periods of high inflation, oil tends to do well. In periods of high interest rates, banks tend to do well. And so I'm probably going to go higher banks, and I'm going to stick with the big tech names. I think I'm going to go with the tried and true. I think I'm going to go with the Microsoft, the Apples, Googles. Probably not Google. They're a little bit on the expensive side for me because I like to carry 100 of a share. And I don't have enough money to buy 100 Google and buy a bunch of other stuff too, so that it's not all Google. And so when I look at the returns the past year, we might think, well, those are boring stocks, right? Wonder what sort of, can I make money off of those stocks? Well, let's see. So if you put your money into Apple last year, you would have gotten, let's see here, year to date, you would have gotten a 36% return. If you compare that to, say, something like JP Morgan, for instance, let's say that you went in the year and you had JP Morgan. JP Morgan would have a 25% return. Apple would have a 36% return. So Apple outperformed the banks. Now, what about the oil companies? Let's see. My favorite oil company that I like to buy is ConocoPhillips. And there's a reason for that. The reason why I like ConocoPhillips is because they profit at less of a price per barrel of oil. They start profiting earlier than, say, Chevron or Exxon do on a barrel of oil because they're just a better run company. Wow. Huh. So Conoco went up 80% last year. So that would have been a good one. What about Microsoft? MSFT. Let's see how they profited last year. Microsoft up 53%. So all of them did really well last year. All stocks, pretty much did well. All stocks that made money, that had some sort of value, did well last year. And that's going to be a theme. Try and stay away from a lot of stocks this year coming up, especially in that time period that we talked about between January and June. Those stocks that do not have earnings, that are basically your big growth stories. I would probably go for ones that I think that have a little bit of a tailwind in an inflationary environment, and one that has a tailwind when there's higher interest rates. And that's going to be my plan for 2022. I think that's going to wrap it up for today. Well, Louis, before I wrap it up, I'm going to talk about one thing here, and that's the GDP is still going to be good. They're expecting the GDP to be good next year, although Goldman Sachs downgraded it with Build Back Better failing in the Senate. They downgraded the GDP next year. And now, for the reason we probably talked about, they're going to pump a little less liquidity into the market. So we would expect that there's going to be less people spending money or certainly less money. So they're going to bump down our GDP just a smidge for the Build Back Better. Unemployment rate, we're at full employment. That's usually it's going to foretell that basically interest rates are on the rise, are going to be coming. They're looking at that their inflation is just going to go down. So whether they're using the word transitory or not, they believe it's transitory. And that it looks like that they're planning on 3 rate hikes. If so much of people's wealth is tied up in the stock market, if they feel like the inflation is under control and GDP is looking good and you got full employment and the stock market's doing fine, I doubt they're going to do anything to ruin too much of that. I also don't see a place where the stock market, where interest rates are just going to rise out of control. Like, because right now people are buying up these bonds like crazy. They won't let that price rise. It's like there's a lot of people fleeing to safety and buying these bonds at the current price. They're not going to, whoever it is buying these things isn't going to let it get over 3%. They're probably going to stop it around 2.5%, maybe percent. But who knows? I mean, I can't tell the future as that's concerned. But again, interest rate rising just means you have a strong economy. So that's I'd love to do a video about what's happened historically when the economy is really good and or when you have interest rate hikes. And I know in 2018 it came straight down, but there were other things involved there. But just historically, I would just imagine that a strong economy with interest rate hikes would probably lead, at least in the 6 months after an interest rate hike, would say it would probably be fine. The stock market would probably be just fine. But that's what I'm picturing for 2022. I hope you, please, if you got anything out of this video, feel free to like and subscribe and turn on that little notification bell. And then I'll be releasing a couple of smaller videos. I've got a little time off from work. I'll be releasing some other types of videos that explain certain things that as I talk about through these videos, such like price to earnings ratios, things like selling options, things that I use in my regular day-to-day trading life. And then, yeah, please like and subscribe, and we'll see you next week. Have a good day.